You're watching Personal Finance with Coach Kelvin. Let's get into the video. Hey guys, Coach Kelvin here. Today, I want to talk to you about offset accounts which are linked to your mortgage. So obviously when you use credit to purchase a house, you're borrowing money from a bank, and what they're doing is charging you an interest rate in order to use that money to purchase that asset. Now this asset is essentially collateral, and if their house can no longer be paid back by you due to a loss of job or something like that, then the bank needs to take this house back off you and then resell it. So lowering your interest obligations will actually allow you to have more freedom to pay that off quicker, or to free up some cash flow to invest elsewhere if required. Okay, so I want you to think about your mortgage as the line of credit, and then an offset account is essentially a high interest savings and spending account which is linked to that line of credit. Okay, so your mortgage is a loan, and this account that is linked will hold funds from which you spend, you pay your mortgage, you pay for all living expenses, or you save money. Now, whatever the interest rate is of that line of credit or that mortgage, the funds which are in the offset account will essentially wipe off the same amount of money that is owing on that mortgage. Now, whatever that interest portion of that is, you will not have to owe money on. So let me break this down. I'm going to make very simple figures and numbers so that this is easy to understand, okay? Let's say you have a mortgage of $400,000 exactly. In your offset account, you have $50,000, and your interest rate is 2.5% on the mortgage, okay? So this $50,000 in your offset account is going to wipe out that money that is in the mortgage to the same value, lowering the interest obligation you have to just $350,000 worth. Now, when you're paying 2.5% on $50,000 per annum, that's going to reduce the amount of money you need to pay by $1,250 every single year, because that $50,000 is reducing your interest obligation on $50,000 within that loan. So having money in your offset account is going to save you money in interest repayments on the loan. Now this works very differently to earning money, because if we earn $1,250, we're going to have to pay income tax on that to the tax rate which our income falls into, okay? When you save this much money on your interest obligations through your mortgage, you don't have to pay a taxable component on that, because instead of earning money, you are reducing a liability, or you're reducing that bill, okay? So a saved dollar is more efficient than an earned dollar, due to the fact that we don't have to pay tax again on money we save, okay? Now, especially here in Australia, it's very convenient and very useful to have mortgage offset accounts. However, there can be hidden fees, there can be little tricks that banks use in order to get you to sign up to products which actually may financially not better you, okay? So we're going to have a look at the fee structure of offset accounts and how this can be tailored to work for you, or work for the bank, in fact. So let's say that your offset account, and quite often this is the case for most banks, you have a monthly fee of $10, okay? So $10 per month just to use an offset account. This is going to require a $120 payment per annum, essentially, okay? Because 12 months times that $10. Now, to withdraw or reduce your tax liability on that interest or that earned money, okay, what happens is that $120 is taken out of the money you have in your offset account, which is actually going to reduce that money that you then have wiping out that same dollar value on your mortgage, meaning that your interest obligation then comes back up. Yes, by only $10, but this happens every month. So with my previous example, where I explained to you that you would save $1,250 per year in your interest repayments by having $50,000 in your offset account on a 2.5% interest rate mortgage, okay, when I explained that, If we then take that $120 off that, our interest repayments are essentially only reduced by $1,130. Okay, so we take $120 off that total amount that you would have saved in interest, and bam, we just add another fee to that. Now, this is quite a significant amount, you know, it's just shy of 10% of what you would have saved by having that 50 grand in your mortgage offset. So it's very important to try and find a financial product that works for you, that has low fees. Because think about it, if you only had $10,000 in that offset account, then you're almost going to have all of that offset facility eaten up, or that offset bonus eaten up by those fees. So it only really becomes financially viable once you have a significant amount of money in that offset account. And if we looked at the 2.5% saving on our $10,000, if that's all we had in our offset, then you're going to basically save $250 a year, but it's going to cost you $120 to save that. So you're only saving $130 a year. So you have to weigh up the options. Is it really worth it, or could I park those funds into a different vehicle to earn a better return than having it in the offset? Now, a mortgage offset account can be a brilliant place to park an emergency fund. Okay, so if you want to sit on a lot of savings to cover a few months living expenses in case of emergency, putting it in a mortgage offset just makes the most sense. This is going to save you in interest obligations. It's going to reduce your interest liability, obviously, and it's going to give you peace of mind that you can withdraw that money out of the offset account at any time should you require to do so. Now, our mortgage offset, when it is linked to a variable rate interest loan, this makes the most sense, because often those variable rate interest loans that have an offset account attached, 100% of the funds that are in that account will wipe out that same dollar amount into your mortgage. But if we get a attached fixed interest loan with a offset account attached to it, what's very strange about this is they'll often market it to you as $0 for that offset account in order to use it. So you think you're saving money. But then they might say this offset account is only going to cover 40% offset. And this is actually the product I have. So my home loan has a 40% offset facility on a fixed interest rate. Meaning on my 2.5% interest, it's actually 2.49, but I'm keeping it very simple. On my 2.5% interest, I'm really only saving 1% interest, because I'm saving 40% of that, not 100%. So let's use a very simple figure here. If I have $1,000 sitting in my offset account for the entire 12 months, only $400 of that is going to wipe out debt within my mortgage. So it makes more sense to actually just put that money straight into the mortgage, where I get 100% write down on that dollar value, and then just go into the bank and withdraw it should I need it later on. And I just keep all of my regular spending dollars in my offset account. So I never usually have more than about $1,500 in there. Banks can be very sneaky in this regard, because for me to sign up to this product where I get the 2.49% interest rate, the free offset accounts, free in inverted commas, and have a reduced interest rate, basically they charge an annual fee of $395. Now, I had to run the numbers for this to make sure it was actually still viable for me to go down this path. But previously, I was paying 3.72% on my mortgage, okay? And when I then shifted my mortgage over to a different product that actually had the fixed interest rate at 2.49%, this was actually going to save me a few $1,000s every year. So it did make sense in my situation. However, if you already had a low interest rate and you were unable to improve that interest rate with a fixed rate by March, it may make sense to keep it variable with the attached offset rather than paying a hefty fee just to get that fixed rate a tiny bit lower and then a free offset account. However, with some packages, and my one has access to this, however I do not have it, you can also use that fixed rate fee to write down the cost of having a credit card. So if I were to open a credit card, it would actually be inclusive in that fee and I wouldn't have to pay an extra fee in this credit card facility. So having access to a mortgage offset account, which wipes down interest onto your mortgage, meaning you're going to have a saving per annum, can make a lot of sense if the numbers work out for you. If you're going to pay an extra fee, so remember previously with $10 a month, my fee would have only been $120 every single year. Now that fee has become $395, but at the saving of about $3,000 per year, it makes a lot of sense to have shifted to that fixed interest rate with only a 40% offset, because I don't want to sit on that much cash anyway when I feel there are better investment opportunities within the share market, peer-to-peer lending and cryptocurrency than just simply paying down a low interest liability on my mortgage. Because of this method also, I'm able to make my rental income, keep that house cash flow positive because the interest rate has lowered so much by fixing that mortgage, meaning I'm no longer losing money every single month. I am in fact making money every single month. So guys, mortgage offset accounts, they can be very sneaky because banks will not always be very clear and transparent as to the hidden fees that they are putting onto your offset account. They will sometimes try to trick you into signing up for products that are worse off for you. So you need to sit down and thoroughly crunch the numbers, because if you fix your interest rate for a slightly lower mortgage rate, but that means you're going to lose more in the fees than you would have by having it at the previous rate, then it's not always worth the risk of fixing it. For me, it made a lot of sense, but for you, it may not. So always do your research. And I'm not a financial advisor, so if you want more clarity on this particular field, make sure you reach out to one or even a mortgage broker and see if they can tailor a product for you or figure out what would be the best option for you. Guys, property ownership can be very stressful, so don't worry if this goes over your head a little bit. Feel free to comment down below and I'm happy to answer any questions and try and steer you in the right direction. I'll try and make property as unstressful as possible so that later on you can venture into that investment class if you do so wish. Guys, thanks for watching, and if you got any value from today, please like, share and subscribe, and I look forward to seeing you in the next video.